We're closing in on 2013. We're supposed to get a big fiscal cliff deal. So what does that mean for the economy and, more importantly, for investing? What are you supposed to do? Our guest is Gary Shilling, who's the president of A. Gary Shilling and Company. Gary, despite the fiscal cliff deal, you think we're going to be in a recession or a quasi-recession again next year? Assuming you're right, how do you invest around that?
Very, very cautiously. I think you play it with a risk-off kind of approach, and that means that you probably look for more appreciation in long-term Treasury bonds, which have been a favorite of mine since 1981.
So let's stop there. So for 5 years, Gary, I've been interviewing you for Daily Ticker. Every year you come out with new predictions. You say, it's bonds. Everybody says, Gary Shilling is a fool. Bonds can't perform once again. And every year, like clockwork, interest rates go lower and lower. How long is this going to continue?
Well, it can't last forever. My target now for the 30-year Treasury, which is now 2.8%, is 2%, and for the 10-year, it's 1%. And it would make sense. I mean, I've only bought Treasuries for appreciation. I couldn't care less what the yield is as long as it's going down, because the price goes up. But if you go from 2.8 to 2%, you'll make about 10% on a coupon bond if it takes place over a year and you collect the interest as well. And on a zero coupon 30-year Treasury, you'd make about 16%. And I think that could be a lot better than stocks, which to me are vulnerable.
So what a lot of people will say is, fine, maybe there's a point on the price, but the interest rate differential and the long-term inflation risk, stocks versus bonds right now, stocks are by far a better investment for the long term. You can collect your 2% dividend or whatever it is. You've got the potential for price appreciation. Over here in bond land, at some point inflation is going to come in and kill you. You're getting the 1.5-point yield or whatever it happens to be. What do you make of that?
Well, that could be, but I don't think that's going to happen until we get through the deleveraging, which I think has probably got another 5 years to run. And in the meanwhile, if you look at 2013 in terms of stocks, I think earnings are the real risk. And you got three aspects of that risk. One is the top line revenues. If I'm right, we've got a global recession. Revenues are going to be damaged. Secondly, profit margins. American business has done a super job of cutting costs. They had no pricing power. Volume increase was very limited, but they've seemed to run out of the ability to promote productivity and profit margin expansion by cutting costs. Maybe they're scraping the bottom of the barrel. Maybe they picked the low-hanging fruit. They got to wait for more to ripen, but that seems to be out of the way. And the third thing, of course, is a strong dollar giving them currency translation losses. Foreign earnings, exports are worth less in dollar terms. And I think we could see $80 in terms of operating earnings per share on the S&P 500 in 2013.
Down below the 110 that most people are
that's
expecting.
right.
So a devastating
the street are looking for over 100.
So I listen to you. It sounds like we're headed for disaster. I listen to everybody else. They say, my housing is turning up. We're going to get the fiscal cliff deal. We're finally getting through the deleveraging. It's fine where the jobs numbers are starting to look good. Everything's finally getting headed in the right direction. You don't think so?
I don't think so. Housing, you and I can remember in 2010 when everybody got enthusiastic in housing because they had the new homeowner tax credit, and a lot of people bought houses for a quick flip. Well, they end up calling them landlords because they couldn't sell them except at losses. They own them. I think that the fundamental problem with housing still is excess inventories. Now, a lot of them aren't visible, and realtors are saying, hey, give me more houses to sell. But there are houses that they're vacant. They're foreclosed but not yet sold. They're houses that they're vacant, but they listed them earlier. They couldn't stomach the bids. They pulled them off the market. That category, the Census Bureau calls it vacant houses held off the market for other reasons. Very descriptive. But that's increased over 1 million houses in the last 4 years. And when you think that we're building now about 800,000 annual rate, boy, that's a huge excess. We think in total there's probably 1.9 million extra houses over and above normal working levels. And excess inventories are the mortal enemy of prices. So I think with the likelihood those inventories are going to come out of the woodwork, that there is vulnerability in house prices.
Does that mean we get a drop, or do we just move sideways?
No, I think we could get a drop, and it would take from here to go back to the long-term trend that Robert Shiller, professor at Yale, has established going back to 1890. It would take a 21% decline in prices from here to get back to trend. And you often have an overshoot on the downside, just like we did in the bubble on the upside.
Gary, sobering as usual. Great to talk to you. Have a great holiday season.
Thank you.